Hi, everybody. Welcome to week one, PowerPoint one, I should say, of RFM 315. So as you go through the PowerPoint, I want to pull out a couple of things that are really important to talk about. So the first thing I want to talk about is the chapter will tell you that there are two key factors necessary for any business to survive. And those factors are profitability and solvency. Profitability really is just talking about the business's ability to generate revenue and manage expenses in such a way that there's money left over after all the bills are paid, right? And that is the key goal of any business. This isn't a hobby, this is a business, and we need to generate income and hold on to profit. The second key factor for business survival is solvency. And solvency, by definition, really just means a business's ability to pay its debt. So as we talk about financial statement analysis, we need to know that there are four main financial statements. Many of you have had me as a teacher in culinary math or strategic management, and you'll know that for me, part of the secret sauce of our hospitality courses and degrees that we offer is that we're not just teaching you how to be good at your craft, whether it's service in the front of the house or with people, or whether it's in the kitchen or in the bakery, but we also teach you that it's really important to understand how to be a good financial manager and a good business person. So we will learn how to analyze financial statements in order to make really good strategic decisions about the future and performance of our business. So to understand how to do financial analysis, we need to look at a couple of things. First, we need to look at the past performance of our business. How have we done historically? What are the present conditions that we're in the market, that our business is in? And then we can make goals for our future performance. So in order to look at financial statements and analyze those, you need to understand that this isn't an accounting course per se. Finance and accounting are two very different degrees, two very different practices, and two different disciplines. So your book talks about crunching the numbers. That feels like accounting, right? Crunching the numbers is just making sure that everything is accurate. Financial analysis is much more than that. It's having an understanding of accounting, but then looking at the numbers and seeing what story are these numbers telling us, and how do we react in response to the story that our operations or our solvency or our profitability is telling us. So in order to do a good financial analysis, first thing is we have to understand that there are four main financial statements that a business manager will use. The first you probably heard me or another professor talk about in culinary math. That one is the income statement. We also talk a little bit about that in strategic math. The income statement is kind of like, I compare it to your paycheck. All the money coming in, all the bills and the checks that you wrote out, and then hopefully there's money left at the end, right? So the income statement starts with total revenue, then you'll see all the expenses, then you'll hopefully see net income. The second one that we talk about is the balance sheet, right? And students sometimes have a hard time. The balance sheet seems like it's so tricky, right? So hard to understand, but I want you to really just think about it. It's called the balance sheet because it must balance. So I want you to think about it like a balance scale. Both sides must be equal. So the balance sheet looks at all the assets of a business and how the business got those assets, right? And there's only two ways to buy an asset. You can buy them with debt, or you can buy them with your own money, and your own money in finance is called shareholder or stakeholders' equity. So assets equal liabilities, debt, plus shareholders' equity, the amount of money that we put in, right? If you want to buy a car, you either have to get a loan and put some money down yourself, finance 100% of it, pay 100% of it, right? There's only those three combinations of things that you can really do to get an asset. The same is true of any asset that you want to buy in business. The second two financial statements we don't use too much, but you're going to look at a cash flow analysis, and you're going to also look at retained earnings. Oh, I should say that when we're also comparing financial statements. We will do a horizontal analysis, and that's going to be looking at trend analysis. Then we'll also do a vertical analysis, right? And they call this a common size analysis. So when we're common sizing, we're taking things off of statements and we're putting them in percentages. We'll get into that in the PowerPoints in weeks to come. Financial ratios can be classified into 5 main categories. And ratios are very cool because you can pull something off. You can pull something off the income statement and something off the balance sheet and then tell you the relationship or the story that those two pieces of data are telling you. You can pull them both from the balance sheet. You can pull them both from the income statement. But we're going to get into 5 main categories. The first category is profitability ratios. How well is the business doing at holding on to profit? We're going to look at liquidity ratios. Liquidity are also known as short-term solvency. So what is your short-term ability to pay debts? We're going to look at asset ratios. We're going to look at your financial structure or your capital structure ratios, right? How is your business funded? Are you too debt heavy? Do you have too much debt? Are you not using debt well enough to grow? Are you equity heavy? So we're going to be looking at those financial structure ratios, and we're going to also be looking at some market ratios. Talk a little bit about some of the ratios that you'll see in your book. So gross profit can be found on the income statement. And the gross profit percentage, you'll look at all the sales, the total revenue, minus the cost of goods sold. For us, that's food cost. That number is gross profit. You'll take that and you'll divide it by the total net sales to get your gross profit percentage. We also look at profit margin or profit percentage, right? For that, you'll also look at the income statement. You'll look all the way down at the bottom and say, what is your net profit? And then you'll divide that by net sales to get your profit margin or profit percentage. We'll also look at return on assets, right? So return means how much profit are you able to make on the assets you bought, right? So we all want to buy shiny new assets, right? New stoves or a new food truck. But in order to do that, it's our job as business managers or owners to produce profit from those assets. So return on assets, we'll look at net profit, which can be found on the income statement. And it'll divide that by your total assets. And remember, assets are found over on the balance sheet. We also will look at return on equity. Equity is what the owners own, right? So this is going to focus on how much profit are we returning based on the money that the owners of the company have invested. So for that, we're going to get 1 from the income statement. We're going to get net profit there. And then we're going to get the average equity from the balance sheet. We can talk about liquidity or short-term solvency ratios. A key one is the current ratio, and this is going to look at current assets compared to current liabilities. Both of those can be found on the balance sheet. A good, healthy current ratio is $2 of assets to $1 of debt, right? So for every $1 in debt you take, you have $2 in assets to pay that. That's healthy. $1 to $1 is acceptable. Below a 1 is considered unhealthy for the current ratio. The quick ratio is a second solvency ratio or liquidity ratio, but this time we take current assets, but we subtract out inventory, right? Inventory is a current asset. What you have in your walk-ins, what you have on your shelves, you bought that, so that becomes an asset. You own that, but you want to sell that to produce revenue. So for the quick ratio, we take current assets found on the balance sheet, we subtract inventory, and then we divide those by current liabilities. So that about covers it for this week. If you have any questions, you can always text me or send me an email, and I will see you in the classroom.